Not understanding the nuances of the three critical accounts payable documents has caused more than a few accounting professionals and controllers countless hours of anguish. For one tiny misstep with regard to these documents can translate into duplicate payment, paying for something the supplier was supposed to pay for, paying too high a price, or even worse, fraud. This means countless hours spent trying to get money back, fix mistakes, or even more grueling, explaining what went wrong to management. Never. To help you avoid these fates, let's look at these documents and the potential problems and what you need to do to avert these headaches. Let's start with purchase orders. Well, that's where it all begins. A purchase order is a document that is issued by a company's purchasing department when placing an order with its vendors or suppliers. They then become the customer, obviously. The document indicates the details and the terms that the goods are to be purchased on, such as type of goods, quantity, price, payment terms, and anything else that might impact the sale. So, for example, if the supplier is supposed to pay for customization, that should be included there, whatever it is. In simple terms, and this is important, it is a contract drafted by the buyer when purchasing goods from the seller. Now, notice I said contract. It's important to realize that the purchase order becomes a legal contract once it's accepted by the seller. Not when it's created by the customer with their fingers crossed that maybe the seller won't notice something, but when the seller actually accepts it. Thus, it is critical that it be filled out completely and accurately. Companies rely on the purchase orders as they make communication with suppliers easier and assure accuracy of their orders. They also, if they're done correctly, give them some price safety, if you will. The purchase order, when used correctly, protects both the buyer and the seller. And now let's talk about some problems. First of all, duplicate purchase orders issued in error can mean you end up with double goods. Manual data entry errors made on the purchase order can mean you don't get the protection that you think you're going to get. Incomplete purchase orders can mean that you don't have the legal document that protects you. For example, there was a recent court case in Michigan where the judge ruled that because a purchase order did not have the quantity filled in, the purchase order therefore wasn't a legal binding document. Now, whether other states are going to follow, I can't tell you, but the important point here is to fill in the purchase order completely, and then if you're the party receiving the purchase order, of course, you want to review it before you accept it, because once you accept it, you're basically accepting the terms. And even though some folks will try and put different terms on the invoice, and then you get into the famous battle of the forms, really, it's the purchase order that will rule the day, or at least as of now, that's what it is. Okay, now let's move on and let's talk about the receiving department, the receiving document. The receiving document is a document included with the delivery of the goods, and it delineates everything that is in that particular shipment. It is supposed to be reviewed and matched against the goods delivered by the staff that's actually receiving the goods. Sometimes it is, but sometimes it isn't. And when it isn't, that can create all sorts of problems that we're going to discuss shortly. Sometimes when the goods are received, a formal receiving report is filled out verifying what was actually received. Okay, now let's turn our attention to problem. Okay, failure by the receiving staff to verify what the receiving document actually states matches what the goods that were actually received can create all sorts of problems. It can lead to issues when trying to verify the invoice. It can lead to paying for goods that were never received, because don't forget, once the receiving department signs off saying they were received, you can't prove that they weren't. It can lead to an overstatement of inventory in that case, and it can make it look like inventory was stolen when actually none was. None of these are issues that anybody really wants to face or deal with. Now, let's turn our attention to invoices. Simply put, an invoice is a fancy term for a bill. Now, warning, it is the document that is most likely to be incorrect. And that's why most organizations will use what they call a three-way match to verify that the invoice is correct. The invoice should include a list of the items that are being billed, the quantity, the price, and any other additional fees that are to be paid. And And these items, by the way, should all be verified before the invoice is scheduled for payment, because you don't want to pay more than you should, and you don't want to pay twice and whatnot. The invoice also should have an invoice number on it. It should reflect your purchase order number, and it's going to be sent out for approval. So if there is no purchase order involved, so then there's no purchase order number, it should include the name of the person who placed the order. This is to make it easier for the accounts payable department to figure out who the invoice should be sent to for verification that yes, you actually did order these goods, and yes, no, it's not a fraudulent invoice. And criminals will send fraudulent invoices in the tons, okay, trying to steal some money. In addition, you should be aware that about 25% of all companies, of all suppliers, vendors will now send duplicate copies of invoices. It's just their way of trying to get paid. It's a real annoyance, and it creates a lot of extra work for your accounts payable staff, but they do it. You should be aware of it, and you need to have controls in place to make sure that you don't pay an invoice twice, because getting that money back is not a simple matter. And you can ask your suppliers to stop doing it, but it's an ongoing problem right now. Okay, so let's talk about some other problems. So when you actually look at the invoice, it could have an inaccurate price, it could have an inaccurate quantity, it could have incorrect payment terms, it could include charges that the seller had agreed to pay for. And you need to verify this before you make the payment, because once you make the payment, the money's gone. And as we said earlier, the invoice is the document most likely to have an error. That's why it's critical that the invoice not only be approved, but its accuracy verified before the payment is made. Now, sometimes people say, well, if the invoice is approved, why do we have to verify it? Didn't the purchasing agent double check all the details before they approved it for payment? And the simple answer to that is no. In most cases, the purchasing professional has not verified the accuracy of the invoice, the accuracy of the pricing, the quantity, etc. They've just verified that, yes, they did order this. And even, by the way, if they were to verify that, yes, we ordered 100 widgets, yes, we agreed to pay $2 a widget, and they were green and they were, class ABC, whatever, that doesn't mean they're not verifying that was actually received. That's why we do the three-way match. We match the invoice with the receiving document with the purchase order. So yes, even if they were to do that, and most of them don't, you still don't know that when you got all those widgets, none of them were broken, that it wasn't a partial shipment, etc. So all this needs to be verified before the payment is made. So that's why best practice organizations will turn to a standardized process known as the three-way match to make sure you do it correctly and you get all the nuances associated with the three-way match. Click on the link that has appeared on your YouTube screen and is in the description. It will explain to you everything you need to know about this extremely critical process. Good luck.